What was the Emergency Banking Act? Have you ever wondered how the United States managed to stabilize its banking system during the Great Depression? One key piece of legislation that played a significant role was the Emergency Banking Act of 1933. This act was part of President Franklin D. Roosevelt's New Deal policies, aimed at restoring public trust in banks and preventing further financial chaos. The Emergency Banking Act was a direct response to the bank runs that followed the stock market crash of 1929. Many people lost faith in banks, leading to widespread withdrawals and further economic decline. To address this crisis, the act introduced several important measures. First, it initiated a 4-day national bank holiday. During this time, all banks were closed to allow 4 inspections. Only those banks deemed solvent could reopen, while insolvent banks were either reorganized or shut down. This temporary closure helped calm the panic and rebuild confidence in the banking system. Another significant provision of the Emergency Banking Act was the creation of the Federal Deposit Insurance Corporation. This organization insured bank deposits up to $2,500. By guaranteeing that depositors would not lose their savings, the act helped to prevent future bank runs and reassured the public. Additionally, the Emergency Banking Act granted the president more executive powers to respond to financial emergencies without needing to consult the Federal Reserve. This allowed for quicker action during crises, which was essential for stabilizing the economy. From a liberal perspective, the Emergency Banking Act represents a major government intervention to protect the public interest. It aligns with the liberal ideology of using government action to tackle social and economic issues. By stabilizing the banking system and safeguarding depositors' funds, the act played a vital role in mitigating the effects of the Great Depression. The Emergency Banking Act also set a precedent for future government regulation of financial markets. It demonstrated the importance of government oversight to ensure public welfare and protect consumers. Establishing deposit insurance directly reflected the liberal focus on safeguarding individual rights and interests. In summary, the Emergency Banking Act was a crucial step in stabilizing the economy during a time of severe financial distress. It not only helped restore confidence in the banking system, but also laid the groundwork for future reforms aimed at regulating financial markets and protecting consumers. This act is a clear example of how liberal ideology influenced government actions during a critical period in American history.